We're still not live.
There it is, sister.
Good morning. Good morning. Welcome to Secure the Bag with me, your host, Stephanie Beard, aka your Laker Girl. Thank you guys for tuning in. It is Monday, February 23rd, 2026. We are ready here 2 months in January and in 2026 already. The time is moving, you guys. You got to get your portfolio together. That's why I'm here. I'm here to help you and assist you to learn how to buy stocks, trade stocks, and all those things. I am here every Monday and Friday, 7 a.m. on the JK Network, giving you just my opinion on how I trade stocks and also just to educate. So I'm going to be breaking down the market in simple, disciplined steps. But before I do, I have to get in my disclaimer, of course. This is not financial advice. Everything is for educational and entertainment purposes only. I am not a licensed financial advisor. Please trade at your own risk tolerance. This morning, what we're talking about, we're going to be talking about stock splits, what they are and why companies do them, and the pros and cons. And most importantly, we're going to be talking about what intrinsic value really means, because just because a stock looks cheaper doesn't mean it's actually worth more. So let's get into it. Let's build that bag. All right, you guys. So let's get into what is a stock split. What is a stock split? A stock split is when a company increases the number of shares while lowering the price per share. So your total value stays the same. I'm gonna give you an example. One share at $100. Okay, say you buy one share for $100, and then the company does a 2-for-1 split. Now, what happens is you have two shares of at $50. So it just is an actual split. They just split it. So you still have the same total, which is $100, but they just split it. So it's not like you're changing the value of the stock. They're just giving you more stocks and just split it into a lesser value. Lesser amount. And what splits does is it changes the share count, not the wealth. So just remember that. All right, we're going to get into what is intrinsic value. Intrinsic value. Now, this is where people really get confused. Intrinsic value is what a company is actually worth. It's not the stock price, and it's not the hype, it's not the headlines. In simple explanation, what intrinsic value is based on earnings, revenue, growth potential, assets, and business strength. And what it is a stock price is what you pay. Intrinsic value is what you get. So why does this matter with splits, intrinsic value? When a stock splits, the price goes down and the shares go up. But intrinsic value, it actually stays the same. So here's an example. Before the split, you could put up like intrinsic to slide 2 or slide 3 actually. Before the split stock, the stock equaled $1,000, okay? And after the split, the stock equaled $100. It looks cheaper, but the company didn't suddenly become more valuable. So a stock split can change perception, but it doesn't change the value. So uh, just remember that intrinsic value and the split stock. Now, this is I got to tell you about split stocks because sometimes there's something called reverse split. Reverse split. A reverse stock split is when a company reduces the number. So it's really the opposite. It reduces the number of the shares and it increases the price per share. So your total value, of course, will stay the same. And before the reverse split, say for example, you own 10 shares at $10. So the total equal $100. After a 1-for-10 reverse split, you now own one share at $100, which equal a total of $100. So it didn't make your investment grow. It just combined your shares. Now, you're probably asking, why do companies do reverse splits? It's because I want to say a lot of people miss this part. They do it because they stay listed. They want to stay listed on the stock exchange because sometimes stocks can fall below a penny and then they'll eventually fall off of the stock exchange and you can't purchase it no more on certain platforms. So if the price drops too low, the company risks being delisted. And the stock has fallen significantly. So that means the company is trying to clean up their appearance. And then it has this psychological effect. So, for example, say a 50-cent stock looks weak, but a $5 stock looks stronger. So a reverse split doesn't fix the business, it changes the price. So there are risks involved when there are reverse splits. And this is where some beginners really get hurt because the stock often keeps dropping after the split. It just continues to decline. And then the revenue earnings or growth may be very poor, so it has weak fundamentals. Now, it just makes you have less confidence in the market, and the market you may see the market as a red flag at that time. And there will be fewer shares, and then of course less trading activity, which is because of lower liquidity. So reverse splits often happen after damage and not before growth. So when you see a reverse, please, 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 you might be okay, but not all will be all bad, but you have to look deeper. You got to do your research. You got to get into the company, look at the company restructuring, look at their if they have any strong future plans, if they're improving their fundamentals, and if they have an industry, if the industry is recovering from that loss. So the key question is you ask yourself, is the company getting stronger or are they just trying to survive? And I have stocks that are like that. For one, Purple, if you guys know that company, the mattress company, Purple, man, was doing great, fell all the way down, and the value is just horrible right now. So just remember when you're looking at reverse stock split versus regular stock split, just remember that the stock split increases your shares. Okay, it increases your share, the price decrease, and the meaning is there's some growth behind it. When the reverse is happening, you show the shares are decreasing and the price is increasing, and what it means is warning. There's a warning. Pretty much often there's warning something is going on with that company. So if you see a reverse split, don't get excited. Don't get excited because that price went up. That's not real growth. That's restructuring. And so the real question is, does the company actually have a future? And that's, you can take that down. That's when you know that you have to go back, reassess that company, go and look at their fundamentals. Again, Yahoo Finance is amazing for that. Yahoo Finance break down everything about a company. You can see all their numbers and everything. So I love Yahoo Finance for that, and that's what I use it for. Now, you wonder why companies do splits. They do them. Companies like Meta, they've done it before. Like I said, Tesla have done it. Amazon definitely done it. All these big companies that that reach like $1,000, $2,000, $3,000. I remember Chipotle was a high stock, but it was a high stock. And you wonder why Chipotle was so high, because Chipotle owned the real estate that all of their stores are located at. They don't lease that property. They actually own it, but they did a stock split. And to me, they just haven't recovered well like Meta or Tesla. But most companies split when prices get high, as I mentioned. So it makes shares more affordable for us to purchase them, and it increase the liquidity. It also attract, beginners like you guys, stock beginners, to buy big stocks and get into big stocks. And it also improves the perception of it. So what it is it's easier entry for new investors. It's a more trading activity. It can create momentum and signals, and it also signals that the company is strengthening. And but there's also some risk involved. There's always risk involved when you're trading, you guys. That's why it's good to always have a plan and do your homework, because there's no real value added sometimes, and hype driven buying is also involved. And we don't chase the bag, we build it, and the price can still fall. So it also can be misleading to beginners, and that's usually more when it comes to the reverse splits. Now, what to watch when you do get see a split, or what when a split does happen. Just focus on the business performance. Like I said, Yahoo Finance is amazing for that. Focus on the earnings and focus on the growth and the market conditions, not just the price. So you have to do your homework. You always got to keep a plan when that's involved. All right, it's 7:15. I'm gonna get into the plays today. um, on Friday, I had to sell one of my options. And I know you guys, I know I talk about options, but we're going to get there for you guys. Don't worry. But the market is recovering. It is recovering. When I talked to you guys on Friday, I was actually down. I think it was like 5,000 or plus dollars or whatever, or maybe, yeah, close to $5,000. And within the month, I am still down $5,242. But I have recovered in that 1 week. I was actually down more than that. I mean, yeah, I was down more than that. But right now, I have recovered $1,100 of that money that I have lost. As of right now, one day, I am up only 0.47%, but that's okay. That's okay. The market is doing a little much better. Silver did reach to $75 on Friday, which was good for me because I was able to recover what I actually purchased that option for. But unfortunately, because I did get greedy, I had 3 of them, but I sold 2 and made a nice, very good profit off of it. But that third one, because of the news and because of Trump and his silly self and all his tariffs talking. And I'm happy, if you haven't been watching the news, that he got shut down by the judges. And he went in, put all those tariffs on all these companies. And now they pulled all that back. And so he's embarrassed about it. But now he's saying he's going to go in and implement a 10% tariff on everyone, a global tariff of 10%. So that's what's in the news today. And that is affecting the stock market. But right now, silver is back up. It is moving up slowly. It's up to $78. Longest I'm in the money already because I own more. I own over 5 options right now. So I'll make the money that I lost with that one. I'll make that plus some back because they don't expire until next month. So I'm happy about that. But let's get into some of the stocks that we are watching. You can put those 5 stocks up. APLD. I'm going to push this in you guys' mind because you're going to know about these stocks. Because again, these 5 stocks will help you build your portfolio. Promise you it will. Right now, APLD is at $29.25. It is under $30. It is over a $30 stock. It's been over $30. It is only up 0.90% right now, but it is moving. It is going to get back. It is 100% buy. All analysts are saying this is 100% buy. So APLD is actually should be one of your first stocks that you purchase. It is at $29. It will hit. Let me go to, let's see, APLD. Okay, so the 52-week high is $42.27, meaning that it has hit 40. It has hit that amount already, but it's going to go to 50 and 60 by the end of this year, if not higher. Um, it was as low as $3.31, and it's right now $29. So, and that was in 52 weeks. So just know that APLD should be one of the top stocks in your portfolio. IONQ, um, IONQ is down right now. IONQ and IREN has been down and are slowly recovering. They are slowly recovering. IONQ opened up at $31 today. It is at $31.29, but it opened up at 31.02. Today's low was at $30.51. That's why I'm saying it's down. But the 52-week high on this particular stock is, let's see, market, it's $84.64. IONQ hit $84.64. The 52 week, the lowest that is ever had in 52 weeks is $17.88. So just know that it will go back up to $84.64. Just know that. And right now it's at $31.25. The next target is probably going to be 30, and they move like in increments, 35, sometimes 40, depending on what the news is happening in the market. Let's go to IREN, Irene. I have two options in these right now, and it's up right now $1.05. I'm very happy about that. Now, Irene is a good company. It's a really good company. And Irene is it does, it's a data center business. And, data center is huge in today's market. It is needed for AI. And it's also it also powers Bitcoin. So it actually reacts off of Bitcoin. So Irene is up today. I'm happy. I'm not up a lot, but it's up 2%, and I'll take that. But my option doesn't expire until next month. So I'm actually good to go. Once it hit in the money, I'm going to sell. All right, let's get into the slow moving stock. SoFi, you guys. SoFi is down. That's okay. Let it be down, because that means that gives you more time to buy more of it. $18.09. $18.09 is what SoFi is at. SoFi, again, will be the bank for Gen Z and Gen Alpha initially. It will be the Wells Fargo and the Bank America for Gen Z, especially for them. The 52-week high is $32.73 for SoFi. So that means it hit $32.73. The lowest hit in 52 weeks, it hit $8.60. But it's going to go back to $32.73 and beyond. And last but not least is Lyft. Let's go to Lyft. Lyft is slow. And I keep telling you guys, Lyft is going to be eventually acquired by Google, or it's going to be acquired by Tesla. One of those high-end companies will acquire Lyft, and when that happens, that stock is going to shoot straight up. It is at $13.63 right now. $13.63. And the 52-week high for that is $25.54. So it hit $25.54. It's going to hit that again. No matter what, it's going to hit that. The lowest in 52 weeks was $9.66. If it could go back to that, be happy and buy it. But those two stocks, they take the scenic route, and they will eventually hit over $100. Let's get into Uber. Now, Uber is also, you figure, Uber, you guys, I did purchase Uber, but I did sell it. Uber is down $2.34, but Uber is slated to go to $80. And I believe it has hit 80 and beyond. It is at $71.53 right now. $71.53. The 52-week high for Uber is $101.99. It hit $101 last month in January. or was it December? It was one of them, but I know it hit 101.99. The lowest in 52 weeks was $60.63. So if it could go back down to $60.63, I would jump back in it. But even at $71.52, it's still a good buy for Uber because Uber will go to $100. It's a good stock. It's a good company. It's not going anywhere. If you do um, your uh, your due diligence and looking at the company and their numbers and see how strong they are, you will see that it is uh, uh, a good company. As well as, let's get into the ETFs real quick. We got 5 minutes, 7 minutes. The ETFs, again, you guys, it's the SPY. SPY is a high-end stock. It's $684.67. It's $4. It's down $4.76. But again, like I told you guys, you can buy portions of it. They say you just want to buy $50 or $100. You can do that. SPY is a basket of all tech stocks. It got Tesla in there, got Meta in there, it got all these high-end stocks up in there. So you want to get into ETFs. ETFs are great to get into because it's going to always make you some good money. And let's see, I'm going to tell you what it has in this basket. It has NVIDIA. NVIDIA is a strong company. It has Microsoft in there. It has Google, both A and C, and it has Tesla. It doesn't have Meta. I thought it did, but those are the stocks that are in SPY. So if you want to say, hey, I want NVIDIA, I want Microsoft, I want Google, I want Tesla, all of those are in that one basket. SPY is the ticker sign symbol for that. Another good ETF is QQQ. QQQ. Say that real fast. QQQ. QQQ is at $604. High-end stock, but also a great company. It also has NVIDIA and Microsoft in it, Tesla, Alphabet. They're also in those as well. So that's also a good one to have. Let me see. It has technology in there. It has consumer silicote in there. It has healthcare stocks in there, utilities, energy stocks, real estate stocks, financial services, industrial, and communication services, all in that whole box, in that whole basket. So you can't go wrong. It also it has Meta in that one too. It has Apple, it has Amazon, it has Walmart and Broadcom in QQQ. Let me go back to SPY because I did miss a couple in SPY. In SPY, let's see, I gave you 5 of them. What's in that basket? It also has Apple, Amazon, Broadcom, and I thought it had Meta. Yes, Meta and Berkshire Hathaway. Now, Berkshire Hathaway is one of those top dogs in Broadcom. Those are high-end stocks. All of these are high-end stocks. The last one, but not least, of the ETFs is V like Victor, T like Tom, I. VTI, Vanguard. Vanguards are also good stocks. It's at $337.48 right now. It's down. All of the ETFs are down, which is good because it's good for you. In there, it has technology stocks in there. The top 10 in there is NVIDIA, Microsoft, Alphabet, Meta, Tesla, Apple, Amazon, Broadcom, Google, and Eli Lilly. Those are the top stocks that's what's in that basket. So they all pretty much the same. So VTI is the lowest, but you're going to be able to build your portfolio with those, you guys. All right. So that's it. That is all I have for you guys today. I appreciate you guys being here and supporting. Make sure you go back and refresh anything that you missed. And we're already on episode 14. We're moving fast. Like I said, we're going to get into those. We are going to eventually get into the options. I just want to make sure that you guys know everything about the stock market, what terms and how to purchase, because price is what you see. Value is what you understand. And we don't want to chase numbers. We learn what they mean. And because on this show, Monday is we build the bag. That's why I'm sitting here giving you definitions of terms and things like that. And this is this, we basically Friday, that's when we secure the bag. So I just want you guys to make sure tune in every Monday and Friday, 7 a.m. here on the J Key Network. You guys, I'm going to get up out of here. You guys have a great day today. It is Monday, the first day of the week. Have a great week, and we'll see you back here on Friday. Peace out, y'all.
Peace out, y'all.